I would say expectations have come down quite a bit. I think we've seen negative earnings revisions. Like, for example, we have a basket of companies exposed to China. We have a basket of companies exposed to the US. We have the tariff basket. All of them have seen like earnings revisions down between 10 and 20%. So if you look at the expected earnings growth for the second quarter, I think the expectation is now 0 for Europe. If you take out the financials, it's -4. And that's the only good news coming into the earnings season. The expectations seem quite low. The problem on the sentiment and positioning you asked, it's already quite bullish, it feels like. Obviously, markets have rallied a lot into the summer. There's this Goldilocks flavor that has come back in markets, and the market has relaxed a lot, you could say, after Liberation Day. And there is a risk, of course, that it has gone a bit too far. And what we're looking for in particular is guidance. It's not only the results. We want to understand how the companies are actually dealing with the tariffs, how they're dealing with the potential slowdown in the second half.
Interesting. So it feels like even though earnings expectations are incredibly low, markets don't reflect that necessarily. So more downside risk potentially to come through earnings season.
I mean, you definitely have seen valuation expansion. So the best way to put it is like earnings revisions haven't been particularly great or down in a few specific areas. And you have seen risk premia come down. Part of that has been because of hopes for dovish monetary policy pivots. And more recently, I think the Fed obviously has been very much in focus. So I think the Fed easing was also one of the core drivers behind David Kostin upgrading his price target yesterday. So I think like this kind of faster than expected easing is helping a lot support the equity market.
We have now in the rearview mirror a new commission, a letter report, a Draghi report as well. All of us proud Europeans are desperate to see the fruits of all of that being sorted out. You're at Goldman Sachs. Have you seen any of the fruits coming through?
Listen, I think we have the German fiscal stimulus, and I can tell you that's an important anchor. When I travel globally, seeing investors, the fact that you have that German fiscal stimulus, it's quite making it quite unlikely that you ever go back to negative rates.
Money at it, Christian, and there are those politicians in Europe, including in Southern Europe, who think just throwing money at it without efficiency reforms, without regulatory reforms, without making us smarter in terms of banking, that you're just going to chuck money at it and it's going to be ill spent.
No, I think you're right. I think you want to focus on productivity. You want to focus on efficiency. And we're seeing that a bit here and there. Think about the consolidation in the European bank sector. I think there's plenty of things going on in the background, but I agree, like, as always, Europe is a bit more incremental, small steps. There's no big, beautiful bill. So as a result of that, it's a gradual process. But what I would say, though, is politicians, especially in Germany, seem to have embraced a bit more this kind of make Europe great again.
Is it? Come on. We know that the German politicians, whether it was Herr Scholz's government or whether it's Herr Merz's government, neither of them want that consolidation in Europe being led by other Europeans rather than Germans.
I agree on the banks consolidation, but what I would say is there's changes in expensing. There's changes in, obviously, spending, fiscal infrastructure spending. There's changes in defense. I think we are seeing a bit of a regime shift in Europe, where I think the political system is becoming a bit more friendly for growth. But I agree with you. It's baby steps.
Lots of small dull bills, I think, is what we're seeing in Europe instead of one big, beautiful bill. Yeah. Can I just ask you what's left on the trade, though, as we have this conversation? Because industrials have escalated. You've seen European banks also rally as well. A lot of this seems to be already priced into markets. Would you agree with that, or do you think there's something still left on the table?
I think the expectations into especially the EU deal seem quite optimistic. I agree on that. Like most people you speak to, most market commentary seems to be expecting that they will avoid significant tariff increases, reciprocal tariffs, they will have exemptions. So I agree with you, the expectations going into the most important outcome for us, but also probably for markets because the EU is so important. I think there is a bit of expectations baked in. But I would still say that in general, like we've been consolidating. No, I think the cost of equity for equities is like 10 to 12%. So if you are flatlining for some time, which we've had, which just recovered in a lot of equity markets, then you're essentially building a bit of a discount. But I agree with you, just the price performance we've seen since Liberation Day shows that we've seen a lot of relaxation.